You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on The Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Global Investments. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, Swan Defined Risk Mutual Funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody, that music means it's time once again for the Advisor's Option, the program here on the old Options Insider Radio Network, where we break down the sometimes mysterious, sometimes just impenetrable world of options for you, the busy financial advisor who's got other things to do, quite frankly. You're busy managing your clients' accounts, and you don't have time to keep up with the latest and greatest, or perhaps stay on the cutting edge of the information coming out of the world of options. Don't worry. We do it for you. My name is Marc Longo from theoptionsinsider.com, as well as, of course, on the aforementioned network. And if you enjoy this program, I welcome you, I urge you to upgrade your subscription pretty much wherever you get this fine program. Could be iTunes, wherever, whatever platform you use. Go on over to the full network feed. Get all 15 shows, including the Advisor's Option every month, but also Options Bootcamp, Option Block, Volatility Views, all that fun stuff. It'll keep you busy, I guarantee you, if nothing else, and certainly very well informed when it comes to options. And of course, we do love to hear from you guys on this program as well. So if you have questions, I know a lot of you do, hit us up via social media, via the website, via email. Questions at theoptionsinsider.com also works there as well. And we'll try to filter as many as we can through onto the show each episode. And joining me on the old program today, starting off, one of my usual cohorts, my partner in crime here. He is Matt Amberson, the principal over there and the founder over there at ORATS, Options Research and Technology Services. Matt, welcome back to the Advisor's Option. It has been too long.
Mark, it's great to be here. Happy to get on again, and there's no hurricane, so that's awesome.
That's true. I wish we could talk advisors every day. There's so much going on out here these days. Certainly have enough questions to do quite a bit of show. We'll see how many we can squeeze on today. And you mentioned the hurricane. We had a little bit of the shuffle on the deck here today, listeners. As a result of the hurricane, our friends over there at Swan are obviously HQ'd down there in scenic and sunny Puerto Rico, 10, 11 months out of the year. It's a great place to be. Hurricane season, not so much. So as we are recording this, they are hunkering down for their second major hurricane in as many weeks. So hopefully everyone there stays safe and everything goes off without a hitch. But never fear, listeners, we are joined by a different arm of the ever-growing Swan contingent. He's been on the show before, even though it has been a while. He is Marc Odo, the Director of Investment Solutions over there at Swan Global Investments. Marc, welcome back to the show. It's been a while.
It has been a little while. Good to be back.
And it's good timing to have you on, Marc, because I think we have a topic today that's right up your alley. So without further ado, let's do it. Let's kick off our tricks of the trade.
And now it's time for practical tips on how to implement options into your practice. It's time to learn the tricks of the trade.
All right, everybody, welcome to the Tricks of the Trade. This is, of course, the portion of the show where we break down, like the man said, some interesting tips and techniques and sometimes some interesting conversations that we're having here in the world of options. And today's topic actually grew out of a conversation we had on the last episode of the program. We had some listener mail, I believe, that pulled us into the realm of active versus passive. I think we also had some data on the show talking about that, and it led us kind of down an interesting rabbit hole. And we thought it'd be a good topic to save for a future episode. And as it so happens, Marc happened to join us today to talk about the whole active versus passive debate, as well as how options fit into that. And it just so happens Marc's the right guy to bring on because he happened to have just completed an interesting white paper on this very topic and taking, I think, a very interesting stance. I think you'll be able to determine it. Of course, you can read it for yourself over there on the Swan website. We'll put a link to it in the show notes and on our site as well. The title is Active versus Passive. It doesn't matter. I like that title. A little bit of a provocative title because it is, quite frankly, the hot debate in the space right now. We're seeing a lot of money. I'm just going to cite some of your own research for you here, Marc. According to your own paper here, passive mutual funds added up nearly $500 billion in 2016. This is from Morningstar, whereas active managers lost about almost $250 billion in 2016. So you can see clearly the trend has been in one direction. Obviously, we like options here, so usually that tends to accrue to a more active mindset, but I think there's room for discussion for both. So, Marc, tell us kind of what got you thinking about writing this paper, and why did you take your somewhat provocative stance of it doesn't matter at the end?
Right. Yeah, so I mean, certainly this is one of the most contentious things in finance right now. I mean, you can't pick up a newspaper, turn on the television, or hear anything on the radio where people aren't arguing about the relative merits between your traditional stock pickers versus the Vanguard, BlackRock type model. And when I say active, essentially what I mean are those guys to add value, add alpha by making marginal bets, by picking the right stocks or over-underweighting sectors and outperforming their index by, maybe a couple hundred basis points per year. That's their target. Now, the arguments on either side have been well hashed out. Everyone's heard these before. On the active side, people say Vanguard doesn't really allow for the efficient allocation of capital. There's no attention being paid to valuations, earning fundamentals. And as a result, you get these herding into the overbought asset classes, usually the largest capitalization stocks. Now, of course, on the flip side, the guys on the passive side say but most managers at the end of the day fail to outperform. Our fees are close to zero. And trying to find those handful of guys who are going to outperform the benchmarks in advance, it's difficult. Now, I'm not telling anyone here anything that they haven't heard before. Everyone's heard these arguments, but our response, Swan's response, maybe is a little bit different, a little bit contentious, and that's it doesn't matter. It doesn't matter. When I compare those different types of managers, at the end of the day, it really doesn't make a whole lot of difference. And that kind of position, obviously, is going to need a little bit more clarification here. So essentially what we mean by that when we say it doesn't matter is that this whole debate that everyone's having is about relative performance, right? Now, both active and passive managers share market risk, and it's always been our philosophy that market risk is the biggest risk to any investor. Now, it's kind of funny that this whole debate with active versus passive has come with the tailwinds of this now 8.5-year bull market, where having a luxury about who's outperforming by a couple hundred basis points or maybe a couple dozen basis points, it's a luxury that we could be talking about that and be focused on at this point. It's been 8.5 years since the market's lost 50%, and that was really what people were focused on. So that's kind of the gist of the paper. I've got some numbers and some things I think are rather interesting I can share with you. But, that's this whole our whole angle on this active versus passive debate.
It's kind of funny because I think a lot of people would probably assume when they see you guys and what you guys do for a living, which is of course effectively actively hedging long portfolios, they would assume you would probably come down on the active side. So it's kind of interesting to hear you guys of all people kind of arguing and advocating the fact that it doesn't really matter at the end of the day. So walk us through some of that data. So you got some interesting data here, and you mentioned systemic risk. This, quite frankly, has always been my big problem with the switch into passive as well. People probably would lump us in the same category. They probably would assume that I am super advocate for super active trading, and that's not necessarily the case. I think people should do what they're comfortable with. Sometimes people very much overtrade, we see, and they end up costing themselves a lot of problems and a lot of headaches and needless complications that they don't need to do. But the one thing that always concerned me about the whole trend towards passive is people will, sure, it's great now when the market is rallying, but look, 2008, 2009, other times when you ride the market up, you ride that roller coaster right back down again, and that's the problem I always had. So I always thought maybe passive, in quotes, maybe passive with a little bit of one extra step, I think could go a long way. But that said, I think you have some good data to share with us, Marc. So let's get into that and some of the impacts of systemic risk out there that kind of really wipe everyone off the board.
Sure. I mean, again, I think those points are very valid. And one of the catchphrases I always kind of live by when it comes to passive investing, the Vanguard model, is that, look, passive funds can't play defense. By design, they are meant to go up in lockstep with the market. But the flip side of that coin is when the markets go down, you've got no defense there. You're going to go down in lockstep with the market. And of course, that's the problem. It's a problem we haven't had to face too much in the last several years here. But that being said, it hasn't gone away. So the angle I took here is like, okay, well, those active managers, and again, the active I'm defining as stock pickers, guys out there in the Morningstar database who are either fall into the large cap bucket or the all domestic equity bucket. I went through the Morningstar database and said, okay, let's define the field first as just large cap blend funds. Then let's make it a little bit bigger. Let's look at all large cap funds, which are going to be blend, growth, and value. And then why not look at all 9 style boxes? We're going to look at all domestic equity funds, mid cap, small cap, so on and so forth. And at the end of the day, I had 1,451 funds to choose from. Now, what I did is I looked at what happened during the financial crisis. From peak to trough during the financial crisis, the S&P 500 itself lost about 55%. When we look at that whole range of all those funds, almost 90% of those funds, over 1,400 plus funds, lost over 50% of their assets. In fact, there's only one fund out of almost 1,500 that managed to lose less than 25%. So again, it's like the main takeaway is like when it comes to systematic risk, when it comes to market risk, choosing the right stocks and picking your way out of a cataclysm, it's just not going to happen.
That was probably the most terrifying statistic that left off the page for me. Obviously, you have some good visuals here. You have a good chart that shows all the drawdowns and kind of where they fall on a percentage basis, and that certainly, I think, is eye-opening for a lot of people out there. Again, I encourage people to read it so they can see these images for themselves. But yeah, only one fund out of the 1,451 that were included in this research were able to lose less than 25%. Think about that, listeners. One fund out of 1,451 lost less than 25%. That's a bit of a stunning statement when you see it that way. And also a little bit terrifying when you see how much money is going into passive and realize a passive usually equates to no defense, and so a little bit of a perhaps a discouraging trend for some people. That said, Matt, you're interacting with people in the advisor space and the asset management space on a regular basis. You guys are obviously, as your name implies, providing research to them on a variety of these different strategies on a daily basis. Before we even get into some ways that maybe advisors and clients can use options as a quote unquote passive investor, what are your thoughts in general on the whole active versus passive? Do you have a dog in that fight, or do you kind of lean both ways like Marc? How do you feel on that?
No, I have a big dog in that fight. And, as a trader, when I put my own capital up, I've always protected that capital. I mean, you could make more money by not protecting your capital, clearly. You can make more money by not having life insurance. You can make more money probably by driving without driving auto insurance. But, everyone wants to protect themselves from a debacle. And I really think that you should be measuring returns based on your debacle risk. And, even a sharp ratio misses that. And what I mean by that is, if you have your portfolio without any protection, you should be judged worse than a portfolio that has some protection. And so, these drawdowns that are experienced, true, it only happens once in a while, but they could blow you out for 10 years until you make back that money, that drawdown, or until you get back up to your high water mark, or however you want to state it. So yeah, I think it's actually quite irresponsible not to have some type of tail protection in there. Now, of course, tail protection gets expensive, and one of the things that we do quite a bit is show people and show firms how to reduce that cost, and marry the drawdowns that are acceptable with the costs for protection. So yeah, I'm big on, you don't have to be in there actively managing every day, but definitely have some tail risk in there, and potentially some income generating to help pay for that.
It is amazing, and some might say horrifying, that in this day and age, 2017, you could be certified as an asset manager, a financial manager, and have all the licenses and things and so on. And of course, you could gain a substantial amount of AUM in this day and age, and yet have no clearly defined way to really protect that capital under your management, outside of the binary decision of going to cash. And then, of course, we all know that there's cost to going to cash as well. So it does seem like it is a little bit horrifying. You think, all these laws and registrations, they would require you to have some sort of fiduciary obligation to do that, but they were more concerned about understanding the laws and not violating them rather than actually implementing the capital. Probably a conversation for another day, but one that I'm with you, Matt. That certainly does bother me quite a bit. That said, Marc, before we get into some other strategies and ways people who self-identify as passive, quote unquote, investors can use these options and still remain kind of passive, what are some, I think, if you have to give someone the takeaways, the keys you want them to walk away from your research from, what would they be?
Sure. So, I kind of set up this conversation with saying that your traditional way of active management doesn't really offer a whole lot of protection, and passive management is going to be fully exposed. So therefore, really the only way to protect yourself from these major cataclysms, these major traumas in the market, is either one, by market timing, which you kind of alluded to, just, being lucky and moving into cash at the right time. And if you can pull that off, great, but easier said than done. Or, of course, the tie into the show today is the use of options. The intelligent and cost-efficient use of options actually can change that dynamic so that you're not tracking the market down in lockstep when these things do happen. And obviously, there's lots of different approaches to it. Swan, we've developed our own way of going about it, but there's many other ideas, all good ideas out there on how to essentially change that dynamic so you're not going down with that sinking ship.
Yeah, so let's get into some of those proverbial tricks of the trade, the ways that, let's say you're the busy financial advisor out there and your client comes to you and says, I just want to be passive, yet you still want to give them some protection. How can you do it? There's a bunch of different ways you can. Obviously, they want to be passive, so we want to keep it to effectively the bare minimum of what you have to do to maintain some defense while still allowing them to maintain their passive exposure. That just means, especially because it's passive, doesn't mean you're not doing things. There's a little bit of, I think, of a misperception that goes along with that term. So we started looking at some ways that people can. We went with just the most ballpark basic ways that you can implement that, so you're not terrifying your client, and perhaps you're not terrifying yourself in the process. And one of the more basic ways to do it is, of course, your basic standard protective put. If your client is long an index, a lot of them like to be long, let's say, the SPY out there, coming in and buying a protective put on an index like SPY can do that. Now, of course, there's different ways to structure it and which month. Obviously, if you want to remain passive, you want to make it relatively infrequent. So we suggested here a quarterly put. That gives you a nice middle ground between going too far out where it's hard, the put can become irrelevant if the index continues to rally after a long time, but also it's not so close to the expiration where it just decays. So 3 months is a nice little sweet spot there, but you can, of course, adjust that. And we picked somewhere in the 5 to 10% out of the money range. Again, that could be determined by you and your client, how much protection they actually want, how much downside they're comfortable withstanding. That's all all a decision you have to make, obviously, with your client. And there's some benefits to this. Obviously, by doing it only once a quarter, it still remains fairly minimally active. So you don't really have to do a lot. The client doesn't have to do a lot, and you can still maintain all that long exposure that you like, so you can participate in all of this rally and all of the benefits therein. Now, the downside, as Matt alluded to earlier, you're not the only person to have this idea. So these puts tend to get expensive, and they tend to be expensive for some time. In fact, Matt, if I had to guess off the top of my head right now, maybe the number one back test you guys are requested to perform on a regular basis over there at ORATS is some permutation of this. Some client coming to you guys and saying, hey, we have this portfolio in X products. We're thinking about hedging sometime in this time frame, this percent out of the money. How does that work out? How do we do it? Am I in the ballpark with that?
No, unfortunately.
Oh, well, I take it all back.
I think, and Mark, you're usually correct, and I wish that were the case, that more people would come to me for tail hedging, but it's not. It's mostly for, income producing or, some type of alpha generation. But I agree. I mean, I think that that would be the number one that I would have predicted. And, I've been beating the drum for a long time on this. And it actually is one of the most important ones to test because, how, if you buy a put too close to the market, it's going to cost a lot of money. And, just like an insurance contract, I'll make that analogy again. If your deductible is low and you're getting paid for every scratch on your car, that's going to cost a lot of money in insurance. What you really want is something out of, farther out of the money. And those are the only ones that are really affordable that won't completely, ruin your return. So I think, it's a couple things. One, we've been taught over and over again, just put your money in the market, set it and forget it. And, we've had a bull market. And so people don't want to buy this tail insurance. And, I could understand why, but again, it does take some testing and it does take some work to understand it. But once you do, you could find that sweet spot that you talked about, Mark.
Do you guys have a sweet spot? Everyone seems to have their own flavor of this. Some people like 6-month puts. I know the guys over there at Swan like 2-year puts and then rolling them after a year. Everyone kind of has their sweet spot of how far out and how far out of the money they go. Have you guys determined a sweet spot you guys like? Let's just keep it to, obviously it could vary by product. Let's just keep it to broad indices. Is there something you guys have seen over your millions of back tests that you've run that kind of stands out for you guys at ORATS as somewhere for a decent sweet spot for the puts?
Yeah, I mean, it depends on the client, and there are some other considerations, in the market, what the volatility levels are, and we do quite a bit of work on that. But if I had to have just a general answer, it's much more out of the money than you would expect, and we don't really use percentages that much, but we think deltas are a better way to understand it, and then also understand what that average percent out of the money. So we kind of put a percent out of the money range on it, but use delta more, and it's less than 10. It's somewhere around 5, even, if you can believe that. So, that's what we look at for the only one that you could really consistently. If you're only going to buy a put. Now, there are some other strategies if you're going to do if you're able to short some particular strategies, I've seen Swan's website, and they do some very interesting things to help pay for other types of options. But if you're only going to buy, you got to go out of the money, Mark.
Wow, that's fascinating. 5 delta. That's to put it in layman's terms, listeners. That's not a very meaty put at all. Obviously, every dollar the underlying drops, that put's only going to move a nickel. So that should give you some idea of how much, or in this case, how little protection you're getting. But that makes sense, Matt, because these things get bid up out of control in many cases. And if you're just doing this, which is the most basic, quote-unquote, passive defensive strategy you could do, as Matt just pointed out, it's going to be costly to get any sort of real protection. You're talking 5 delta put, you're probably talking in the ballpark of at least 20-25%, if not more, of a drawdown you're going to have to withstand out there in the S&P just to have that put kick in. So give that some thought if you're thinking about doing the bare minimum. Let's take it up one notch, Matt. I don't want to terrify the people, but we'll keep it still fairly inactive for the most part. We'll only talk about, let's say, keeping it on the quarterly level or something like that. But we mentioned how expensive it is to buy these puts. What if we, take it up one notch from there and we go to still a very basic strategy, which is the put spread. So obviously you're buying maybe, we were thinking, 10%, 5-10% out of the money puts, maybe a little more, given your research out there. And then you're selling a farther out of the money puts, maybe a 20-25% out of the money, but something along those lines. Obviously, there's a couple of benefits to that. First off, you're reducing your outlay, so you probably can afford to buy a little bit meatier protection, a little bit meatier put, which will probably make your clients happy. But the downside is, for that reduced cost, you get a little bit more reduced protection. You're only protected effectively between those strikes. So if your client is concerned about the end times, the big 2008, 2009 meltdown happening again, then maybe a put spread is not the way to go. Maybe you want to go with Matt's more draconian protection measures out there. So interesting stuff. Matt, have you looked at, obviously you probably have, ways to play with some of the put spreads a bit. And if you do that, does that allow you to get a little bit meatier than 5 delta? Can we get up to an 8, maybe a 10?
Yeah. We've done a tremendous amount of testing with put spreads because that was originally my intuition as well. But, the risk reward, the pay, just getting into those options and the cost to get in and that just, and what you're giving up, didn't, make sense. And, now you can do some that, are, and optimize that. But in general, my answer would be, the put spread is not really, you're gonna meet most people's needs. And it doesn't end up protecting as much as people would expect. Obviously you could change the constraints around, but just for a standard put spread, it's definitely going to reduce your costs, and you are going to get some help and relief on how much you're paying, but in a debacle situation, you're not going to get what you expect. If it Goldilocks right down to the right strike, yeah, you're going to work out. But for the most part, that's not the panacea. The put spread, doesn't really meet most of my clients' needs, Mark.
You're breaking hearts everywhere out there, Matt. Let's see if we can go. The third one will be the charm, the Goldilocks. The other one that comes up a lot when people talk about passive. Again, this is a little bit more active. It's a couple of legs, but it's still nowhere near the extreme end. By the way, that put spread we were talking about, trying to keep things simple. You can do a lot of things to make the put to pay for that longer put. You could sell weeklies, buy 6-month put, etc. We didn't get anywhere like that. We kept it all very simple vertical in the same month, just for simplicity's sake. Of course, as Matt pointed out, sometimes simplicity is the enemy of what you want, which is good protection at a reasonable price. So let's move on to a third idea, one we talked about on the show many times. We've often referred to it as the holy grail for financial advisors out there when it comes to options positions. This is, of course, the collar. It combines two things, pretty much the two strategies that most financial advisors say they want when they come to options. They want protection and they want income, and that's exactly what this strategy provides. It provides buying a protective put, perhaps somewhere in that same range you're talking about before, and also writing a covered call against a long underlying component. Let's say in this case it's SPY again, it's the S&P. So you're selling that covered call, which most advisors are familiar with as an income trade. You're buying that protective put and you're combining them. And there's a couple of different ways you can combine them. Obviously, we're not talking very active here, so we won't get into the active structure. We've seen, like our friends at OIC have done a lot of great research on the efficacy of collars across a broad array of underlyings, and they've come up with an optimal structure of 6 months on the put. And at the time, writing a monthly call, I do suspect if they were to update that research in for the last couple of years. They may even move that to weeklies because weeklies have become such a big part of the options market. But we'll have to ask them when they decide to redo that study. Or maybe Matt and his team over there will take that ball and run with it. But so we've hit on a more passive way to do the collar, which is also a popular way to do collars. It's effectively, usually it's the collar in the same month, and it's typically referred to as a zero cost collar. And there's some pros to that. Obviously, you're buying a put and you're offsetting it with a collar or a call that is effectively the same cost. So you're getting effectively free protection. That's a nice thing. That's the pro. You're getting protection and it doesn't cost you anything. The downside, of course, is you're surrendering some of your upside. So in an aggressive bull market scenario, you're going to be giving up some of that upside. So that's something to pay attention to. Also, if you're structuring a zero cost collar, you're structuring it with cost as your first priority rather than efficacy as your first priority. So there's going to be some downside to that. And usually that means you're going to have to buy a put probably farther out of the money than you want and sell a call maybe closer to the money than you really wanted to do in order to make those puts and calls line up. So bear that in mind if you are doing that. But this is another way for the quote unquote passive investor out there to still utilize options and still maintain their investments. Mr. Matt, are we 3 for 3 here? Are you going to poo-poo the collar or at least the zero cost version of it as well? Or do you have some thoughts on this?
No, we're getting warmer. I mean, this is what I prefer. And, I would suggest just from the tests that we've run, the call that you want to sell is more out of the money as well. And the put that you're going to buy is more out of the money than you probably would think as well. So those are what generally test the best. We've also done some other timing issues on when to sell the calls, and what we're finding is we have these channeling technical indicators that, and it's counterintuitive, like many things that we test over here at ORATS, Mark. Some of the best times to sell calls is in a slightly uptrending market with a falling low volatility is when you get most of the consistent returns in selling out of the money calls. So, but again, that's more timing. But if you're going to do a passive strategy, again, what the testing shows is, an out of the money call, and closer in 20 days, 30 days to expiration, and then buying an out of the money put, longer duration, 6 months, that reduces your cost quite a bit. Again, you're going to have to endure, some loss. You're going to have, you're not going to be protected all the way down, but I think you get the protection that, someone would want, in a debacle type of a market. And you could get the cost down to, almost costless or, something like 0.5%, 50 basis points on that type of a collar strategy, Mark. So I'm not poo-pooing that. I'm good with that.
There you go. We're 1 for 3 here on that. But you're right. If you are willing to be just a little bit more active, and we're not talking crazy, like we were saying zero cost, which usually keeps it in the same expiration cycle. But if you want to do it maybe the more effective way, which is move the put out a bit somewhere around 6 months, again, as our friends at the OIC have determined, and then do just a simple 1 month covered call and do that 6 times, obviously, for the term of that put, I think the strategy could pay off very well. As you mentioned, you could effectively get free protection or perhaps even get a little bit of a credit on that at the end of the day, depending on how the market performs. So, Matt, is it fair to say then if someone came to you right now with this hypothetical scenario, I'm an advisor, my client wants to be a passive index investor, what should I do for an options strategy for them? Would you suggest this, or is there something else you have up your sleeve?
Well, we're not a registered advisor, so we would just do tests for them and let them, analyze the test. But definitely, what most people are picking when they're looking at the test that we do for them is what you say, some type of a income producing that also provides somewhat a little bit of a cushion on a down market. Obviously, when you're selling calls, you're getting a cushion there, and then the put kicks in. So that's. And again, it's a case-by-case basis. Some people that could be more active can do a better job. I mean, the people at Swan, they have some pretty interesting strategies when it comes to that, and they're pros. I mean, those guys know what they're doing, and it's not just because they're on here, but they, if you go to their website and look at some of their ideas, I mean, they're watching some some pretty well-tested strategies. So, something like that is usually what falls out of the back testing, Mark.
There you go, listeners. We're not done with active versus passive yet. We have some more data on that. So let's get to that in our next segment. It's time to check out the buzz.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get the buzz.
All right, everybody, welcome to The Buzz. Time to break down some of the latest breaking stories and research and developments in the world of options that pertain to you, the financial advisor. And as fortune would have it, there is more data on fueling the whole active versus passive debate. Despite what Mark said, the fact that it doesn't matter, some people are still fighting it out there. And we got new data coming out of, a new research report by Practical Perspectives that pretty much concludes that advisors these days are still sticking with active investments. Their report called Financial Advisors and the Use of Actively Managed Solutions, 2017. A very apt title. Says, despite increased flows to passively managed solutions, most financial advisors continue to rely on actively managed solutions, including mutual funds and separately managed accounts. Again, this is according to the folks over there at Practical Perspectives. Said that most advisors, the percentage of advisors using actively managed solutions has not changed markedly in the past 12 months. According to the research, only 1 in 5 advisors, only about 20%, has decreased their use. They say active management is fundamental to how most advisors work with their clients. It's rooted in many factors, including their desire to help manage portfolio volatility and reduce risk. A bit of irony talking about volatility when most of them don't use options, but that's a conversation for another day. They say providers of actively managed solutions recognize most advisors frame the issue as active together with passive rather than active versus passive. And I guess what we were saying before, you can combine and merge the two. You can be a passive quote-unquote investor and still have some active options or slightly active options solutions in there to help protect against the massive systemic risk that Mark was talking about, and also maybe improve some of those returns, a little bit of income as well. They say their data finds the use of passive solutions is primarily a long-term strategic decision, and advisors do not perceive the use of passive solutions to be a fad. So those of you who are perhaps anti-passive in the anti-crowd, don't get excited about this because it doesn't say passive is going away anytime soon. They say there does not appear to be widespread abandonment of active management, though, among established advisors. And this gets back to the data Mark was saying before, too. High expense and cost are the foremost challenges related to actively managed solutions, but the report finds that advisors using them are generally satisfied with the overall performance. Again, although satisfaction varies widely by user segment. And they say advisors prefer the actively managed solutions in the equity space, but usually when they do so in a little bit more what they term opportunistic categories, so maybe emerging markets and some specialized international areas and things like that. So Mark, after we just got finished saying the debate doesn't matter, here's more fuel for this fire. Does this surprise you that, we just mentioned, as you cited the data from Morningstar, that there's been huge outflows in active and huge inflows to passive? Does it surprise you that at least in our space, in the advisor space here, people are still sticking with the active side, or are you so engrossed in your own research and your determination that you don't care because it doesn't matter?
No, it's no surprise. I mean, obviously, I don't think we could go to a 100% commoditized passive type world. It would just be kind of absurd. I do think what you are seeing is that those people who do place their money with active managers are wanting those active managers to take bigger bets. They are, looking for higher active share. They want the active managers essentially to be earning their keep for charging those fees. The one irony to the whole thing, though, this whole evolution is, in my opinion, this concept known as smart beta or factor analysis, because that's often presented as a third way of kind of combining the best of passive investing as well as a little bit of active management. And people seem to accept smart beta and factor analysis as being an okay thing. But when they talk about active managers being closet indexers or index huggers, they get all upset, right? But really, when you look at where the bets are, I mean, a smart beta guy is really not going to be that different from your traditional S&P 500. So the fact that smart beta guys factor analysis kind of get a free pass seems a little bit weird to me when most people say my active managers are going to take, bigger bets. But there's a diverse opinion. There's a big spectrum out there of what everyone thinks is acceptable and what fits. It's hard to settle, that's for sure.
Matt, any thoughts on this? Does this data surprise you that, we're talking here about massive outflows from active funds in 2016, and yet people in the advisor space still sticking with what they know? Does that surprise you, or is that pretty much what you expected?
Yeah, I mean, we've been marketed to so hard that, hey, just, put your money in an index fund and close your eyes and set it and forget it. And so it doesn't surprise me. I think if again, I've come down more on the, passive investments, but, I think that some smart guys could do better than some, just putting your money out without really, just indexing it. And, and again, I think you need to get that protection. So it's not surprising, but it's a little disheartening to me, Mark.
Well, let's check in on some data on how those quote-unquote smart guys are doing. Let's see the data for these active guys. See if they're earning their keep. There's some data now coming out of Preqin, their All Strategies Hedge Fund Benchmark. They track these things, and they said August is actually a pretty good month for hedge funds, pretty much across the board. And the year so far has been pretty decent. They say that in general, their benchmark up about 1% in August, up 7% for the year. So getting a little bit of alpha there. You can argue, how that compares to the broad market, but that's a conversation for another day. I'm sure the passive people will do just that. If you break it down by strategies, it gets a little bit more granular there. If you break it down by equity strategies, August up about a little over 1%. Year to date, nearly 9%. For macro strategies, August also up about 1%, and year to date just shy of 3%. Multi-strategy, I'm not sure, obviously a broad array of strategies combined there. August only up about 0.6%, but year to date about over 7% this year. So a good year for that. Credit strategies, August a little bit lackluster, only less than 0.5%. Year to date, a little over 5%. What they term event-driven strategies. That's kind of interesting. That's only up less than 0.5%. Year to date, though, nearly 7%. I would like to maybe dig into those numbers a little bit and see exactly what they term to be an event-driven strategy. And then relative value, August up about a little less than 0.5% year to date, just shy of 3%. So depending on the sector, it's been a pretty decent year or a relatively modest year. Some other takeaways, I said emerging markets, the top performing geographic region in August, returning 2.5%, brought year-to-date gains out there in that area to 12.3%. Asia Pacific was the leader, up 10.5% for the year. Europe only up about 6% for the year, and North America up 4.5%. And again, good month for CTAs out there as well. Average of CTAs up about 2% or so for the year. And again, it breaks down by that area depending on what type of trading strategy they have as well. So interesting, a little bit of data here, Mark, on how the active guys are actually doing. So maybe you can decide for yourself, listeners, if that merits their fees or if it doesn't. But still interesting stuff. Does this add any more fuel to the fire for you, Mark, or is this pretty much what you expected out here on the active side for August and indeed for the year?
Yeah, I think it's what I expect. I mean, I don't think this debate's ever going to get settled, and it probably shouldn't be settled. I mean, you need that push and the pull. You need a low-cost option for those people where that is their primary concern. But, on the other hand, you do need a choice. You need to differentiate yourself in the market sometimes. And, sometimes I'm about halfway through writing a blog post, but I was kicking around this idea going back to the early 70s. I mean, what were people talking about then? They were talking about the Nifty 50, right? They said, here's 50 stocks, buy and hold them. That's all you need to do. That's the strategy that's going to take you through retirement. And, of course, everyone knows the Nifty 50 blew up. Well, these days we've got the Nifty 500, right? All that money is going into those top names in the Vanguard 500 index. And right now it's been working out okay for the last 8 years or so. But just because it's worked the last couple of years doesn't mean you can extrapolate that to infinity.
Matt, any thoughts here on how our friends? I just came from the CTA Expo a few days ago here in Chicago, so I had a couple of days full of listening to their returns and then breaking it down by strategy. I was surprised at how popular volatility harvesting strategies are out there on the CTA side of the space. Maybe a conversation for another day as well, but still very interesting stuff. Does this data surprise you, Matt, or is this pretty much in line with what you guys are seeing over there at ORETS?
Yeah, now I'll kind of get into shift gears a little bit because I always think there's asynchronous information out there. As a market maker, I was always paranoid because it always seemed like people would come in and buy puts at the very right time. And as you've probably seen that many times as well, Mark. So, if there is people that know things before you, then, the way to benefit from that is to try to track that, or, just get in a general low cost and protect yourself, because it's very difficult to know what people in the know have up their sleeve. So that's what I always did when I was trading. I wouldn't watch the news all that much. I would just do relationship trading and not try to take too much risk, not think I was too smart. So, I don't know if that fits into what you were saying at the CTAs, but that's the way I think of the market, Mark.
Well, you mentioned contrary information, and that's what we like to talk about here sometimes on The Buzz as well. It is amazing how so many differing studies will come out at the exact same time. Is the old bring some truth to the old statement, there's lies, damn lies, and then statistics. Because we just talked about how, depending on, and again, it depends on your sample set, which audience you're looking at, et cetera, and so on and so forth. But we just talked about how advisors are extremely still interested in active, and active is the way they want to go. And yet here's some data coming out of Charles Schwab. It's their annual survey of, 7th annual survey of investors. Their determination is that they want ETFs, and they want them more and more and more. They found this survey that 27% of their portfolios, of the investors they surveyed, on average, were currently in ETFs. And again, when they mean ETFs, they're typically talking SPY and broad, very passive ETFs. They're not really actively getting in there and slinging different, VXX, for example, or things like that, even though they do trade that one. Compared with 16% only in 2012. So up from 16% 5 years ago to 27% today. Moreover, they said 42% said ETFs would be their chief investment product in their portfolios going forward. That's up from 28% who said that last year. So a big jump from this time last year. They also said millennials like them. 56% of millennials surveyed said ETFs were their investment vehicle of choice, compared with 42% for all investors, and also some other data on kind of what Marc alluded to in his study. This is a report coming out of ETFGI. They said exchange-traded funds and products listed in the U.S. gathered net inflows of $275 billion in the first 7 months of 2017. That's just shy of the $279 billion they took in all of last year. So a market increase here this year as well. And if this data is to be believed, and it certainly sounds credible, then this is probably the trend we're going to be seeing in the years to come. They said 60% of all groups said they use ETFs to reach long-term goals, building wealth, saving for retirement. 62% of them prioritized low expense ratio. 60% said total cost was important above all else when choosing an ETF. Interesting side note, only about 10% said they really were interested in what they deemed socially responsible ETFs. So that's still a small part of the marketplace. So interesting stuff here as well. So we have, on the one hand, the advisors saying they want to stay active, they want to lean towards active products and kind of doing that. On the other hand, the client demand, and that's really where the demand should spring from, seems to be leaning the other way. I don't know, Marc, we kind of determined at the top of the show that the debate doesn't really matter which side you fall on, but it does seem like the inertia is going one way, and that is on the side of the ETFs and indeed the passive. Would you agree?
Well, it kind of gets back to one of the statements I made previously about it's kind of a luxury doing this conversation about the relative merits of active versus passive when, one might outperform by 50 basis points, 100 basis points. If that's the case, then yeah, you could certainly bang the pot about having a low cost option as your choice. But how many of these millennials were invested through 2007, 2008? How badly were they burned by having full systematic risk exposure? I mean, that might change the perspective quite a bit if your SPY ETF loses 30, 40, 50%. That's when I think that having, maybe not just a stock picker guy, but someone who's doing something really different by using options and purchasing that type of insurance, that's when the value really shines, is in the midst of a crisis.
Matt, any thoughts on this data? Kind of a little bit contrary to what we were talking about before, but then again, you're saying you like some contrary data. So what are your thoughts on the trend from the investors coming out of Schwab versus what the advisors were saying just 1 or 2 studies ago?
Yeah, I mean, I could understand more people getting into ETFs. The thing I worry about is they're chasing fewer and fewer stocks. And so what happens is when everyone needs to get out, when the market goes down and their redemptions are selling, what happens? It just exacerbates problems. And so, yeah, again, I'm all for, a low cost option as long as you have some protection. And I think especially with the trend towards ETFs, you could find some decent puts and protection on those types of vehicles, Mark.
All right, before we get you guys on the show and open up our office hours, do a real quick update. You guys are always asking us what's going on with this whole fiduciary saga. That's what it's turned into. On August 30th, the Labor Department filed a 15-day comment period, and they want to delay the provisions effectively of this rule going into force until July 1st of 2019. So you got some time if you're on board, if you're still hemming and hawing about what you need to do to be compliant with this. And again, it doesn't seem like options are on the table, which is a good thing for this. That said, Elizabeth Warren jumping into the fray. I think we all know she's probably getting ready for a run here in 2020, so she seems to have firmly cemented herself around this and a few others as being the populist issues on the financial side that she wants to fight for. So I don't think with senators like that and others getting involved, it probably won't go away anytime soon. She's obviously advocating against that delay. She wants this to be enforced now. So that may cause the time frame to accelerate. But as for now, we have until you have that 15-day comment period, which is coming to an end, pretty much has come to an end. And then, of course, we have until July 2019. So if you're worried, and again, if you're worried about options being on the chopping block, at least so far, it seems like that is not the case. All right, without further ado, let's get into some of your questions. It's time to open up our office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody, welcome to the office hours. This is where you guys ask us questions. Once in a while, we turn the tables on you guys and ask you guys questions as well. We were talking about hurricanes at the top of the show. We asked you guys recently, hey, Harvey, then Irma, then Jose, now we have Maria. Everyone's talking about prepping their houses and their cars and their families for disasters. What do you guys do to prep your portfolios? We gave you 4 choices: getting along some sort of volatility product. Could be VIX, VXX, whatever your flavor is of choice, or going to cash or T-bills, or just buying, as you're saying before, buying puts on whatever you're long. Could be an index, could be an individual stock, or going into the quote-unquote risk assets. And it was a close fight. At the end, it was the volatility products that won, getting along some Vol, VIX, or VXX, got about 31% of the vote. A tie for number 2, 27% saying they wanted to buy some puts, and also they wanted to get into the risk assets like gold. Only 15% saying going to cash. I thought that was kind of interesting. All right, let's move on to some of your other questions. You guys are always hitting us up. Again, you know how to reach us here at the Advisors Option. Probably could do a whole show on questions one day. Maybe we'll do something like that. But let's see how many we can get to here. JV Cavalia wants to know, I have a question for Advisors Option on annuities. Hello, Marc, Randy, Mike, and Eric. So he's going back a ways with the show here with the hosts. I'm very much enjoying your program. I'm still new to options, and I'm interested in annuities. But most of them seem to be overly complex and riddled with hidden fees. Many of them also seem to utilize some form of derivative to achieve their investment goals. The obvious question then is, can I achieve the same results myself just using options? Would writing a quarterly call on a broad index achieve the same long-term income results, for example? Do you have other suggestions? Thanks again. This is a great question, JVC. And, it's something we touched on a little bit on the show in the past. We don't really hit on annuities a lot for a lot of the reasons, quite frankly, that you outline. A lot of them are, A, they are overly complex. B, they're kind of designed just to push fees on the end user a lot. And they don't really deliver what they claim to, which is this kind of endless income stream. And we tend to lean on the active side. If you do have a little bit of options wherewithal, and it sounds like you're getting there from listening to our shows and doing some education on your own, you can recreate and probably exceed a lot of what these annuities do if you have a little bit of knowledge of how to do things like writing covered calls, some of the basic income trades that we talk about. Again, these aren't risk-free. You still have to be long the underlying, so you have to be cognizant of that. So maybe a collar would be a good way to go to have some of that downside protection as well. But if you are a little bit savvy, you can start doing things that can allow you to replicate a lot of these returns on your own without the fees associated with those things and allow you to adjust to. An annuity is kind of a set it and forget it type thing. These are things that you can adjust and change to different market conditions, which is if you want to increase your effectiveness, that's the best way to go. Matt, we haven't really discussed annuities a lot here on the show, but I know particularly in the advisor space, they're a big part of the equation. A lot of advisors like the whole notion of, giving their clients this one effectively structured product, and that's a set it and forget it type approach. It's kind of the ultimate passive approach in many ways. What are your thoughts, A, just on maybe annuities in general, and then B, kind of what JVC is asking here about how a lot of them do use derivatives, and maybe he could do it himself?
Well, you bring up a good point that you need to look at different market environments for different strategies, and that's one of the things that we're able to back test. And if you think about it, you can structure annuity type returns and back test them and give some expectation of an annuity like return using options. And these are some of the things that we do. Try to take the risk out. It's not easy, but it takes quite a bit of back testing. But you can, drill down to some. My clients have gotten some very interesting results. Trying to replicate some annuity type returns. And yeah, you're right. I shy away from annuities because of the costs and such. But again, using back testing options. Testing strategies, optimizing those, you can get some annuity-like returns, Mark.
Mark, you're always out there conducting research and writing white papers over there at Swan. Has any of your research ever delved into the realm of annuities? And if you have any thoughts on them you want to share with our friend here, Mr. JV Cavalia, have at it, sir.
Yeah, it's tough. I think the only takeaway that I have on this particular topic is that, well, first of all, annuities cover quite a few different type of potential strategies. Annuity itself just being a wrapper, but how you get there, what the underlying investments are, could go very widely. But that being said, these insurance companies and the various sponsors of annuities are in the same boat that the rest of us are. They're having to deal with the same challenges that the capital markets are providing for all of us, where we have yields down at infinitesimal levels, and we've got markets at all-time highs. With those basic building blocks, it's going to be a lot more difficult to structure a type of return series unless you start thinking outside the box. Unless you start either introduce more complexity or maybe doing something that's non-systematic use of options. Gone are the days, obviously, when an insurance company could just buy a bunch of 6, 7, 8% bonds and charge whatever they want on it. They're struggling to get that kind of constant rate of return too, and either they're lowering expectations or, like everyone else, taking bigger risks.
All right, everybody. Unfortunately, that music means we've come to the end of another epic episode of the Advisor's Option. As always, we start with one conversation, and it tends to spread into a bunch of others, which is always fascinating and always fun. If you sent in questions, I know a lot of you guys did. We didn't get to it. Don't worry, we read them all. Even if you don't get a chance to answer them all on the shows, we'll try to get back to you in some other format. We'll save. Maybe we will do a massive question and answer palooza here on the show one of these days. A lot of you guys do have a lot of good questions here. Some of them are pretty lengthy. It's hard to fit them in to a given show, particularly when we have some other good topics to talk about soon. But keep those questions coming. We do love to hear from you guys. And before we wrap up, let's go one more trip around the horn here. Let's start with you, Mark. You haven't been on in a while. Obviously, you just did the active versus passive research. What else are you guys working on over there on the Swan research team that we can check out in the blogs in the near future? And what else do you guys have coming up at Swan in the near future?
Yeah, well, one of the things I white papers that's still in draft form right now has to do with performance measurement. Prior to joining Swan 3 years ago, I was at Zephyr Associates for 11 years, and we were kind of front of developing next generation metrics of measuring liquid alternatives, hedge funds, option-based strategies. And it, in a way, it ties back to this conversation with active versus passive, because all of these measures that people use, like alpha, tracking error, information ratio, they only really make sense if you tracking something like the S&P 500. If you are doing something entirely different, there's kind of a lack of good ways to measure whether or not a liquid alt fund or hedge fund is actually doing its. But there are some statistics that I've worked with before, and then I'm putting some papers out and some blogs out that deal like, okay, well, here's how we actually measure whether or not a equity hedge strategy is actually delivering on its promise.
There we go. Check it out. His research, as well as Mika and the rest of the research team over there, SwanGlobalInvestments.com. They have some good stuff over there. So if you're in between episodes of the show and you're saying to yourself, how can I get more advisors, option-oriented type content and research and data? There you go. Have at it over there at SwanGlobalInvestments.com. While you're surfing, of course, don't forget our friends over there at the OIC, optionseducation.org. They couldn't join us here today, but they have a lot of great research and data, including the collar study and everything else over there. You'll see the Advisors tab on the far right corner of the homepage. Click on that, log in, and you're good to go for all the research they have over. I'll see if I can get them to update their collar study one of these days as well. And last but not least, Mr. Matt, if I'm listening to this show and I'm saying to myself, I'm an advisor out there, and I'm saying, you know, I bet you I have my strategy is awesome. It's an awesome way to implement options into my clients' passive portfolios. But I want some data to back that up. Where should I go? What should I do?
Yeah, Mark, you go to orats.com and contact us. Our programmers have been very busy. We have millions of back tests going through. We're now in the cloud, and we've got these ultra fast databases. So it's been a lot of fun. It's been a learning experience for me. Also, a lot of our back testers want to implement their strategies and make it more automated. You know, we talked about the annuities. Well, in order to create an annuity type structure, you have to be consistent in the implementation. And so we're coming out with execution help and automatically watching your exit strategies, because once you get in an option position, you want to check it for exiting, and then checking your performance against the back test, and then scanning. We call it the wheel. It just goes round and round. You scan, you execute, you exit. Scan, execute, exit. So that's what we're working on over at ORATS. Come on by. We could test your strategies quite quickly and help you out, hopefully.
Oh, it's getting into a little bit of the execution and trade optimization area, too. A very hot area these days, and a very important one. Your strategy could be great, but if you execute it poorly, it's going to impact the efficacy and the results at the end of the day. Hit them up over there at the Options Research and Technology Services, a.k.a. ORATS, ORATS.com, to check out a back test for yourself. And on behalf of Matt and Mark, and indeed myself, I want to thank all of you out there in the listening audience for downloading, streaming, and subscribing to the program, and of course sending in such great questions. Keep them coming. Hope our friends over there in the Swan HQ in Puerto Rico are staying safe, and we'll see you next time for more of the Advisor's Option.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Global Investments. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, Swan Defined Risk Mutual Funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.